Thanks very much for your time, and we come together at a time when you've unveiled this MDS strategy, your market demand strategy, which is a 300 billion investment program over the next 7 years to 2019. Mm-hmm. Can you give us some of the main drivers of that program, and who do you feel will be the main beneficiaries?
Look, over the next 7 years, we will invest about 300 billion into infrastructure, capital spending in Transnet. 200 billion will go to rail, about 100 billion split between ports and pipelines, more for ports than for pipelines. The idea really is to improve our efficiencies. The beneficiaries will be our customers, because on the back of the capex spending will be better ability to carry volumes on the system, both on rail and at the ports. And so we expect to be able to carry more volumes of coal, more volumes of iron ore and general freight business, and to put through our system more vehicles that go through our ports through the roll-on, roll-off terminals, as well as the containers that are handled.
And a key customer segment that seems to be a beneficiary is the mining community. You've got big plans in the coal area, the iron ore area, the manganese area. Can you elaborate on some of the thinking over the next 7 years and what some of the action that we'll see around that sector?
It has been said over the last couple of years that the big disappointment in the South African economy is Transnet's inability to carry the coal that it is supposed to carry to the port of Richards Bay, to carry the iron ore that we're supposed to carry to the port of Saldanha, to the general freight business. We have disappointed the agricultural sector in that we've stopped carrying agricultural goods on our trains and so on. And we want to restore that. We want to restore that confidence. We would like to be of assistance to the coal producers for them to export their coal. We want to be of assistance to the coal producers for the coal that they are selling to Eskom, that it be transported on road, and also the iron ore producers, that they're able to export their iron ore and also transport the iron ore that is intended for beneficiation in Vanderbijlpark or in Newcastle, so that we come to the party and assist them in their endeavors. And at the end of the day, this is of benefit to the South African economy, that the economy can perform at a much higher level than it is performing now.
And would you say the miners are all on side with the approach you're taking to your projects, or there's still disagreements with some of the strategic decisions you've made around some of the commodity lines, be they coal or manganese?
Look, in the last year, we've ramped up our capacity to carry volumes. We even surprised ourselves and ended up carrying much more volumes than we thought it is possible, that the miners thought it is possible. And I think that they've received this very positively, have been surprised in certain instances, even cancelled trains. And were embarrassed to say to us that, look, actually we have more trains than we require, we need to ramp up our capacity. So I think they're receiving it well. What we're going to be doing over the next 7 years is continuing on the trajectory that we've started in the last year, of increasing volumes and so on. And the miners are quite happy to do that, because for a long time they've been complaining that the impediment to their work, to exporting what they're producing and creating more jobs, has been Transnet. And so we're going to come to the party in as far as that is concerned.
And you say you've stress tested your ability to improve efficiencies this year, improve volumes, as well as to roll out your capital budgets as planned more than ever. But in terms of being a near monopoly business in certain sectors, how are you going to ensure that you don't over-engineer these projects to the detriment ultimately of the users and the country?
We have paid our school fees with the NMPP project, where I think there was a problem of over-engineering, there was a problem of not very good planning. We have taken the NMPP as a case study that we're going to study very closely, All our managers will have to understand what happened in the NMPP, what are the pitfalls to look out for. Over-engineering is a problem, and in fact on the NMPP itself now we've just been having a disagreement with one of the engineering companies, because I think now we're becoming streetwise about what is being done and what is reasonable and what is not reasonable.
And in terms of that tariff philosophy, you've outlined CPI plus 2% for the 7-year period. Give us some understanding as to your view as to why that is a justified tariff philosophy over the next few years, and how does it differ in terms of the fairly opaque nature of tariff increases that have come in Transnet in the past?
Yeah, we think CPI plus 2 is reasonable. It is CPI, it's above CPI, but we don't think it is inflationary, because the increases in tariffs are going into fixed capital formation rather than into consumption. In fact, we would argue that we are taking money out of consumption, which is the C in GDP, and putting it into I, which is investment or fixed capital formation, and contributing to savings, because the projects, the capital projects that we're investing in now will be around for the next 100 years for future generations to use, and so that is savings. In an economy that has a savings problem, we think that it is very prudent for us to take some of the money through tariff increases to invest in capex.
And your approach of effectively pre-funding some of this capital before the actual asset is in the ground or the infrastructure ready, you're going to be pre-funding through the tariff increases. How do you justify that, especially because the energy regulator hasn't allowed you to do that on the pipelines?
Well, we're going to have to put our case to the regulators about our justification for what we need to do. I think that the energy regulator had been concerned by the increasing costs of the pipeline in that case. And so because of, and I say that was school fees. We've already paid our school fees. We understand better, our capital projects team understand better how to execute large projects. As a result of the pipelines project, we think that we will be able to put a better case and better justification and show that we are spending the capex in the way that we had planned to spend it over the next 7 years.
And the other perennial hairy chestnut is that there's no role for the private sector. Again, you have an answer to that in the sense that quite a big segment of this is going to be raised off the debt capital markets and elsewhere.
Yes.
But the role of the private sector in terms of that, as well as directly in your projects, what do you see for that going forward?
As I said, I mean, the fact that we're borrowing 100 billion from the private sector means there is a role for the private sector. We are just taking away the equity risks of being involved in the project at the equity level, but we're giving them an opportunity to buy Transnet bonds and be involved with guaranteed return, if you like, of bond return. But over and above that, there are instances where we will identify projects, for example, the branch lines, which will be concessioned out to the private sector, as well as the biggest PSP that will ever happen in this country is going to be the Durban port, the Durban International, the DIA side, International Airport side, which we have now purchased from AXA, which we hope to dig out and develop into a port. The money for the development of that port is not in the 300 billion. We hope to start during this year to start a process to do a build, operate and transfer. So a big private sector player or a conglomeration or a companies coming together will develop different parts, hand them over and have the right to operate over a period of time. And
will that be in the form of a tender this year, or will it be later in the
Let
cycle?
me not say in the form of a tender this year, because there's quite a lot of work needs to go into this before. So it could be this financial year, or definitely by or during the next financial year, we should be able to go out on tender. We expect this project to be finished. It will take 10 to 15 years. It's quite a big project.
And when do you expect shovel in the ground?
5-6 years time maybe, yeah, because there's a lot of engineering that must be done, environmental approvals and all sorts of things that need to be done before the the project is ready. But I think it will take 5 to 6 years. I just visited the Maastricht project in the Netherlands, and it took them 15 years to prepare to get to the ground.
And finally, there is some concern that, as with the government as your shareholder, that you take developmental decisions rather than commercial decisions, and that could impact the effectiveness of these projects, the building of potentially low efficiency or non-optimal lines, or the building of ports that don't really justify themselves. How are you going to be balancing your developmental role versus that of being a commercial operator in the interests of keeping the tariffs low for those that have to use it?
It's quite balanced, really, because if you think about it, we do not intend to get government guarantees for our 300 billion project, which means that we will be borrowing on the strength of our balance sheet. There will be solid revenue growth in the 7 years. There will be solid EBITDA growth and cash from operations. In fact, to the extent that we will be able to fund 200 billion of the 300 billion out of cash generated from operations rather than subsidies from the sovereign or from the government. And so there is a balance between the developmental requirements, the need to create jobs. As we have said earlier, we will be creating 588,000 direct and indirect jobs. And yet, we're not doing that with fiscal transfers from the state. We're doing it from operating the business as a business and taking the revenues and investing them in a capex program of 300 billion.